Treadstone offers a loan program that sounds like it's too good to be true. What if you could buy a home for your aging parent or disabled adult child without needing their finances to qualify, or even a large down payment? That is the idea behind the Family Opportunity Mortgage, a little-known conventional loan option that can let another family member use their own income and credit to buy a home for a loved one who can't qualify. In this video, we are going to break down exactly how it works, who it is really for, and what the guidelines look like. I'm Austin, a loan assistant at Treadstone Funding. We help families in Michigan make sense of mortgage programs like these every day. And this is one of those programs that can be incredibly helpful when you understand the rules clearly. The Family Opportunity Mortgage is a specialized, conventional loan structure that allows you to buy a home for certain family members while receiving financing terms that are typically much more favorable than a second home or investment property. Here's what makes it different. You, the borrower, use your income, your credit, and your qualifying ability to purchase the home, but your family member lives there as their primary residence. That matters, because normally, if you buy a property you do not plan to live in, the loan is treated like a second home or investment property. That usually means a larger down payment, tighter rules, and often a higher interest rate. This program is generally used when a loved one cannot qualify for the mortgage on their own and needs housing support from family. The goal is to help families provide stable housing for a parent or adult child with a real need. This program is built for a few very specific family situations that you'll need to be aware of, because it is not available just to anyone for any family member. The most common use is an adult child buying a home for an elderly parent. Maybe your parent is living on Social Security or retirement income and cannot qualify for a mortgage alone. Maybe their current home is too large, too expensive to maintain, or no longer fits their mobility needs. This program may allow you to step in and purchase a safer, more practical home for them. The other common use is a parent buying a home for a disabled adult child. In many of these cases, the adult child may have limited income, limited work history, or credit challenges that make qualifying difficult. Those are the clearest and most established use cases. If your situation falls outside of that, it does not automatically mean there is no solution. It just means you need to talk with a loan officer early, because the other loan structures may be a better option for you. Now let's get into the technical side. For most family opportunity mortgage scenarios, the borrower should expect the following to qualify: a minimum 620 credit score, a minimum 5% down payment, a debt-to-income ratio generally below 45%, with some cases stretching to 50% if there are strong compensating factors, full documentation of income, assets, employment, and existing housing obligations, documentation of the intent of the home and why it's needed. The key point there is that the borrower must qualify. If you as the borrower have a mortgage or existing debts, those debts are factored into your qualification. You'll need to qualify as is for this new mortgage on your own, even if your loved one is helping to pay the monthly expenses, as you are the one that's responsible and liable for the mortgage payments. When comparing the down payment requirements for this type of loan versus purchasing an investment property, the difference is significant. For an investment home, lenders typically require a down payment of at least 15 to 25%, depending on several factors, versus the family opportunity mortgages of 5% down payment. This is where the program gets more specific. To use a family opportunity mortgage properly, the transaction needs to meet the spirit and structure of the guidelines. A few big rules matter most. First, the home must be a primary residence for the family member who will live there. This is not for a vacation home, not for a casual family arrangement, and not for some rental strategy disguised as family support. Second, the family member occupying the home generally must not be able to qualify for the mortgage on their own. That is a foundational part of why this loan structure exists. In many files, that means providing a letter of explanation or other documentation that supports a proper need. Third, the property itself needs to meet standard conventional property requirements. In other words, it should be safe, functional, and move-in ready. This is not usually the right program for a major fixer-upper. Fourth, the occupancy needs to be specific and long-lasting. The loved one should be moving into the property as their primary residence, and the occupancy should expect to continue for at least 1 year after purchase. This part is important because it helps prevent confusion. The Family Opportunity Mortgage is not a general-purpose program for buying homes for any relative in any situation. It is not a workaround for buying a second home with better pricing. It is not an investment property strategy. and it is not the right fit if the person moving into the home can comfortably qualify on their own. If this program doesn't seem like the perfect fit for your needs, there are a few alternative solutions to consider. 1. Joint mortgages. A joint mortgage allows 2 or more individuals to combine their incomes and resources to qualify for a home loan. This option can be especially helpful if you're planning to purchase a property with a loved one or family member. By sharing the financial responsibilities, you may qualify for a larger loan amount or better terms while reducing individual financial strain. 2. Gift funds for down payments. Many loan programs allow for gift funds to cover the down payment. If a family member is willing and able to contribute financially, this can help you lower your upfront costs without needing to pursue a specific program. Be sure to follow any lender requirements for documentation of the gifted funds. 3. FHA or USDA loans. FHA and USDA loans are designed to make homeownership accessible, especially for first-time buyers or those with lower credit scores or without large down payment savings. These loans often have more flexible credit requirements or allow for a lower down payment, making them a viable option for many buyers. Each alternative has its unique requirements and benefits. It's important to evaluate your specific circumstances and consult with a trusted mortgage professional to determine which path is best for your goals. If you are wondering whether this could work for your family, here are the main questions to ask. Is the occupying family member an elderly parent or disabled child? Can the family member qualify for a mortgage on their own? Can you qualify while carrying this new housing payment? Will the property be used as the loved one's primary residence? Does the home meet standard conventional property guidelines? If the answers are lining up, then it is worth having a deeper review with a loan officer. The best first step is not home shopping, but a conversation with a licensed mortgage lender first, like Treadstone Funding. You'll need to start by talking with a loan officer who understands how family opportunity loans are actually structured. We can help you review income, debt, assets, occupancy plans, and whether this specific program fits your situation. From there, the process usually looks like this. Number 1, initial consultation. We talk through your goals, your family situation, and the property plan. Number 2, document review. You provide items like pay stubs, W-2s, or tax returns, bank statements, and details about your current housing costs. Number 3, pre-approval. We calculate what you may qualify for and whether the file appears to fit family opportunity guidelines. Number 4, property search. You look for a home that matches the occupancy need and property standards. Number 5, full application and underwriting. We submit the file, document the scenario clearly, and guide you through conditions and closing. And if this program is not the right fit, that does not mean the conversation stops there. It just means we look at the next best tool. If you want help sorting through whether this could work for your family, reach out to Treadstone Funding. We are happy to walk through the details, answer your questions, and help you figure out the smartest next step.